Okay, so let me get this straight. You slap a surprise $600 million tariff bill onto a legacy heavy machinery maker, and they somehow respond by growing earnings 30%? That is just wild.
Well, it is. But I mean, when AI data centers are frantic and buying up literally every power generator you can build, you can apparently afford to absorb a few taxes.
Fair point. Welcome to Earnings Unscripted, everyone. Today we are digging into Caterpillar, ticker CAT. This is their first quarter of 2026, and today is April 30th, 2026. And look, before we get too deep into the diesel fumes, just a quick reminder that everything here is our personal opinion. This is not financial advice, so please do not base your life savings on our podcast.
Or our tractor analysis, really.
Heavy machinery, Miro. Give them some credit. But honestly, the numbers this quarter are massive. Total revenue came in at $17.41 billion. That is up 22% year over year. Diluted EPS was $5.47.
Which is exactly what crushed the tariff fears. The street was expecting, or actually everyone assumed, the tariffs would wreck the bottom line. And yes, the overall operating margin did tick down slightly. It hit 17.7%, down roughly 40 basis points.
Yeah, but no one cared. The stock price action alone tells you the whole story. It gapped up hard pre-market and just kept running. Closed up nearly 10% today at $890.11. People were absolutely not looking at a slight margin dip.
No, because they are entirely focused on the backlog. That is the metric that matters right now. It exploded. They added $12 billion to their backlog in a single quarter.
Oh, a record $63 billion total backlog. That is a small country's GDP sitting in their order book. And what is crazy to me is how much they're trying to modernize the business at the same time. Like down at the retail level, they just rolled out this CAT compact portal at ConExpo to make buying tiny loaders as easy as ordering shoes online.
Sure, the retail tech is cute, but let's be real. The market is pricing them like an AI infrastructure stock today. They are essentially the invisible layer of the tech stack. If you want prime power for your server farm to run independent of the grid, you call Caterpillar.
And they are definitely picking up the phone. I mean, they're tripling their large reciprocating engine capacity just to keep up, which is quite the exit strategy for Andrew Bonfield, retiring as CFO after 90 earnings calls, just as they kick off this massive CapEx supercycle.
Perfect timing for him to hand off the spreadsheet, honestly, because building that much new capacity is going to burn cash fast. Their cash and equivalents actually dropped from almost $10 billion down to about $4 billion this quarter.
Ouch. That is, almost a 60% drop in cash in 3 months? That's a really aggressive bet on future demand.
It is. They bought a mountain of stock and they're building factories. It's a very confident, very expensive stance.
All right, let's get into the details.
Right. And to understand that confidence, you really have to look at what they are actually selling right now. Because, I mean, an industrial company dropping massive capital on a 3 times factory expansion is usually a huge red flag.
Yeah, it feels like textbook peaking behavior. You overbuild right before the market cycle rolls over.
Exactly. Except these are not your standard, buy a generator just in case orders. They are securing what management calls frame agreements that are running all the way out into 2028.
Wow, 2028. Because they're not just selling backup power anymore.
No, and that is the absolute crux of this quarter. They are selling prime power.
Okay, explain that, just for people who maybe do not read commercial generator specs on the weekend.
Right, sure. So standby power is essentially an insurance policy so your server farm does not crash when the local grid goes down. But prime power means the generator actually is the grid. Data centers are literally bypassing utilities entirely because local utilities just do not have the gigawatts available to feed these massive AI sites.
Which makes Caterpillar, practically a private utility company for the tech sector.
Pretty much.
That is such a wild repositioning. Joe Creed even joked on the call that they're providing the, quote, invisible layer of the tech stack.
He did, and then he followed it up with something you almost never hear a manufacturing CEO say out loud. He said that in his entire career, he has never seen a better line of sight to getting a return on capital. They literally have price escalators locked into these multi-year contracts.
Okay, so they're effectively locking in future profit margins today to justify blowing through all that cash on factory builds.
Roughly, yes. And we should clarify, a massive chunk of that cash drop was an aggressive $4.5 billion stock buyback. But the core operational spend is heavily de-risked by these contracts. The problem, though, is that this entire shiny AI infrastructure story is masking some serious structural pain on the other side of the business.
Oh, you're looking at resource industries.
I am. The mining and heavy equipment side. The operating margins there completely cratered.
Just fell off a cliff.
Down 700 basis points year over year.
Jeez. That is brutal.
Yeah, they went from a healthy 17% margin down to just 10%. And management pointed to tariff costs as the primary villain there. It wiped out about 500 basis points all on its own.
Wait. I am actually confused by how the market reacted to that because Wall Street was acting like Caterpillar's first quarter tariff hit was a win. Like they somehow outsmarted the worst case scenario.
Well, they only outsmarted their own internal model. Kyle Epley, the incoming CFO, kind of walked through this on the call. They had this internal projection expecting an $800 million hit based on older import regulations. But then a recent U.S. Supreme Court ruling forced a legal shift. So they stopped tracking those old rules and swapped over to what is called Section 122 tariffs.
Ah, okay. So absorbing a $600 million penalty is considered favorable just because it was not $800 million.
Corporate math at its finest. But the cold reality is they still expect $2.2 to $2.4 billion in total tariff costs for the full year 2026. That is an enormous operational headwind they just have to swallow.
And they are trying to cover that up by raising prices on the machines.
They are. I mean, they managed to claw back about $426 million through favorable pricing this quarter. But you can only hike prices on mining trucks so many times before your buyers just step away, especially if commodity markets soften.
Which probably explains why they finally closed the deal for RPM Global.
Right, the Australian mining software firm.
Yeah, like if you cannot sell more iron because of tariffs, you pivot to selling them high-margin software subscriptions instead.
Which is a very smart long-term pivot. Software always scales better than diesel engines. But right now, today, that specific segment is just bleeding from these immediate global trade costs.
It really is a tale of two entirely different companies. They are essentially printing money in power generation to feed this AI hunger, but their legacy earth-moving business is just taking a brutal beating from international trade politics.
That is exactly the dynamic. And the real trick for management is bridging that gap.
So where does this actually leave them heading into the rest of the year?
Well, it leaves them running incredibly hot. They revised their full-year guidance upward. We are now looking at low double-digit revenue growth for 2026, and they even bumped their 2030 long-term growth targets up to 9%, which for a 90-year-old metal bender is practically a software trajectory.
Right, but to actually hit those targets, they have to execute on this capacity expansion without just lighting their cash on fire.
Exactly. They are holding CapEx around $3.5 billion a year to triple that engine output. But management is completely unfazed. Joe Creed literally said on the call that in his entire career, he has never seen a better line of sight to getting a return on investment.
That is quite the statement. He is basically daring the macroeconomic universe at this point.
He is. But you know who is not sticking around to find out if the universe answers? Andrew Bonfield.
Oh, yeah. After 90 earnings calls as CFO, he is officially retiring and handing the keys over to Kyle Epley.
And what a handoff. Bonfield actually noted he could not have scripted a better set of results for his final call. He gets to drop the mic on a $63 billion backlog and leave the $2 billion tariff headache for the new guy.
Here are the keys. Please ignore the engine warning light. So looking ahead to next quarter, I guess the main thing to watch is whether the pricing power actually absorbs that tariff hit.
That and the construction inventory. Dealerships loaded up $1.5 billion in heavy equipment this quarter. They called it seasonal prep. But if commercial construction slows down this summer, those dealer lots are going to get very crowded.
Very true. Okay, I think we have pulled this one apart. Caterpillar is quietly powering the AI boom while trying to outrun global trade taxes.
Just your standard heavy industrial invisible tech layer.
Exactly. Thanks for joining us to unpack it all today. See you next time.
See you after the next call.
And hey, if you want these episodes just dropping right into your feed, go ahead and give the show a follow. As a quick reminder, we actually use AI to help script and voice this entire project to explore how well technology can handle real financial storytelling. So if you have thoughts or a ticker you want us to tear apart next, definitely shoot an email to earningsunscripted@datamadness.ca or just grab the X link in the show notes.
Talk to you then.